Hello, everyone. Welcome back. I'm Justin Maxwell, and I have a special guest today to be talking about a subject that a lot of people don't even know exists for them, or they've heard taboo things about it. I'm super excited because Matt Harrison is here to be talking about the subject of reverse mortgage. And you might be thinking, how on earth is that going to help me as a dentist or a doctor, or how's this going to help my retirement? Well, Matt is going to answer those questions today, and it's going to be exciting because this is the untapped asset that a lot of people don't realize is even available to them. And Matt's going to unlock that for us. So thank you, Matt, for being here.
Yeah, no, I appreciate the opportunity, Justin. And this is a program that for most people is misunderstood at best. And our goal here is to kind of help dispel the myths out there that regard reverse mortgages and how they're used, and really talk about how they've changed over time, how they're used right now as a strategic plan to increase cash flow in retirement. One of the first things that I throw out there to the people that I'm talking to is who wants to just survive retirement. Who's excited about working really hard your entire life and then just kind of doing the bare minimum and just surviving it. And a lot of us kind of fit into that category of, no, I want to thrive in retirement. I want to have a plan that's in place that I can have cash flow I can maintain or even improve, the cash flow that I have coming in during my retirement years. And I want to enjoy life. I want to be able to spend time with kids and grandkids. I want to be able to travel. I want to be able to be healthy. But the number one fear, Justin, out there for our retirees is running out of money. Are we going to have enough there? Is there going to be enough available? Have I planned well enough? To be able to have a retirement that I can thrive in instead of survive.
Yeah, I really resonate well with that because even for high income earners like the dentist and like the doctor, they still have that fear because oftentimes most dentists and doctors aren't saving enough during their working years to have the confidence that the money is going to last. But the reverse mortgage can bring more confidence, can bring more certainty to that. And they can add this, even if they're younger, they're 40 or 50, they can start planning with the reverse mortgage in mind, as we discussed today, to create that certainty. And then if you're obviously beyond the threshold of 62 years, this becomes available to you today and very soon. But even bring it into your planning if you're not quite that age. So don't ignore this just because you're not 62 yet. Like, know that this is an option for future planning to create certainty for yourself.
Yeah. And most people, Justin, they don't need a reverse mortgage to survive. Most of us don't, but we want it as far as what it can do for us to thrive. And I can tell you, it is a part of my retirement plan. I'm 48 right now, just about to turn. And, it is a part of my planning that the moment I hit 62, I will reverse my house. Because again, I understand the math. I understand how it's going to affect the cash flow position that I have coming in and how that's going to affect my other buckets of money that I have that are, right now, 401k, IRA, stocks, bonds, things that I have in that bucket that I've put money into for retirement. And then I've got the income that I have coming in, from, my Social Security and anything else that I might be doing in my 60s and 70s. But, Dr. Wade Pfau, said it best that, utilizing a reverse mortgage will greatly enhance the sustainability of a retirement income. And, for us to be able to look at the different scenarios on what we can do is going to be very, very important there.
Awesome. There's two assets that really have like a bad name in the financial industry. It's whole life insurance and it's reverse mortgage. And yet both of those tools are something that most people are missing out on the benefits of and can bring a ton of value to their portfolio, to the certainty, to their life. Can you explain why reverse mortgages have the stigma around them that they do? And then go a little bit into what's changed, how is this a benefit, and just talk about that, because this is something that needs to be demystified, because I don't think people realize that what an actual reverse mortgage is. So if you can talk about that, please.
Yeah, absolutely. The first time I heard about the concept of reverse mortgage, I'm like, who in the world would do that? That just makes absolutely no sense. The misconceptions that were out there for me, were, well, the bank will own your house, and and you're going to lose all of your equity. You're going to screw your kids over as far as inheritance. And why would you do that if you didn't have to? But the reality is the program, when it was initially rolled out back in the 1980s, it was designed as a program to help those seniors that had run out of money. It was the last ditch effort to dive into home equity and be able to allow them to take it out. But this was not a program that was initially done by FHA. It wasn't a program that it is now today. And so what I'd like to do is say what this program is today, because that's really relevant to what we're talking about. So first and foremost, when you do a reverse mortgage, title remains with you. All right, just like a normal mortgage, there's a lien on the house, and that lien, someday will have to be paid off. Now, one of the advantages of a reverse mortgage is that you don't need to make principal and interest payments when you have it, and so those become optional. And we look at a couple of different things. I've got a couple of different props here, Justin. This one here is a rubber $100 bill. For those that have kids and grandkids that went through the squishy phase, this is a squishy. But what this does, this is home equity, right? So the mortgage that I have right now, I'm making payments every single month. So I'm taking these and I'm paying down a loan balance, and I'm creating this. I'm creating home equity. And home equity is great. It's nice to say that you have it, but I can't go to the store with this and go buy something with it, right? And if I'm making my payments, I can't ask my loan servicer, hey, can I take some of this home equity and have it back? I've been really good at making these payments. Can I have some of that back this month? I'd really like to take a trip over to Europe. And, of course, the loan servicer is going to look at you and say, yeah, Matt, that's not how this works. But with a reverse mortgage, the payments that if you, like, for example, let's say you currently have a loan and you're currently making payments. If you don't need to make those anymore and you're 62 and over, I would, create the argument that it's not smart to take this, which is so important in retirement. Justin, we've already kind of defined that the most important piece about retirement, along with being healthy, is how much cash flow do we have? And the biggest worry for our seniors are we going to run out of money? Do we have enough available to us? And so 46% of Americans that are over 62 are making a housing payment, and many of them don't have to. And if you could stop making a housing payment, you're immediately cash flowing the payment that you don't need to make. That's now, you're able to retain that money and use it for whatever it is that you want.
Which is thousands of dollars a month for a lot of people. Like, we're looking at $1,500, $2,000, $4,000, depending on people's house sizes. That's a lot of money every month that is currently an expense that doesn't have to be.
Right. And so the idea of, if I don't need to make a payment, that payment becomes optional. Now, I do need to still pay property taxes, homeowners insurance. I need to maintain the property, need to keep it as a primary residence. These are going to be important pieces to a reverse mortgage. However, if I don't need to make a principal and interest payment anymore, that now cash flows back to me, which is important. Now, just like with a normal forward mortgage, there's a lien on the home, but the bank does not own your home. Okay, so one of the biggest misconceptions out there is, hey, if I do a reverse mortgage, I'm giving my property to the bank. That is not the case. You retain ownership, you retain title, and when you pass, the title then goes to your estate however you have that dictated. Okay, you're also not stuck in that home. You can sell the property if you choose during this period of time. Any of the equity position, which is the value of the house minus the amount borrowed, is yours. When you pass, the equity position then goes to your estate. But what happens, Justin, if the loan amount happens to be higher than the value of the house? Let's say that this home is underwater as far as that's concerned. Well, with a reverse mortgage, this is not a worry because this is a non-recourse loan. And what I mean by that is that the heirs of the estate would never have to come in and pay back more than the value of the house at the time of death of the borrowers. So for the estate, there's the benefit of knowing that they could have equity position in the home if there's equity remaining, and they can even retain the house. Once mom and dad pass, they can either refinance the loan balance and retain the home, or they can sell the property, pay off the loan balance, and the remaining equity is there for the estate. But they will never be stuck with a bill at the end, which is really important.
So let me just clarify that just for simplicity's sake to make sure everyone understands that. So if the reverse mortgage loan was $500,000, but the value of the house was $450, and the heirs get it in the estate and they sell it at $450, they don't owe anything to the bank. It's just the bank. It's done. Everyone, it's just washing your hands. There's no extra fees due. There's no penalties. Everyone walks away, and that's just the way it is. Is that correct?
Yeah, they could even wash their hands of it completely, Justin, and say, hey, we don't want to even deal with this. Here's a deed in lieu, bank, it's yours, and there's no repercussions against the estate. Now, if they want to purchase it, Justin, there's a really neat provision within the reverse mortgage that would allow a guaranteed short sale at 95% of the current appraised value. So in other words, if, back to your example, if the loan amount was 500 grand and the house value was only 450, the heirs of the estate, if they wanted to keep the house, could come in and purchase it at 95% of that $450,000 appraised value and retain the house. And they still don't have to come in with a shortfall. That's one of the great things about the reverse mortgage, is that it is a non-recourse loan and it works that way.
Well, I think that's really important for people to understand, because I think this situation we're describing is one of people's biggest fears, is that my parents are going to die forever and the loan's going to get out of control and it's not going to appreciate fast enough. And then we're going to be stuck with this massive bill. But there's no reason to have that fear because of the non-recourse loan feature of the reverse mortgage.
Right. Now, Justin, there's a couple of pieces to this that are really, really fun. So we talk about the fact that principal and interest payments on a reverse mortgage are optional. Now, what happens if you decide to make a payment? Now, Justin, do you have a mortgage right now?
I do, yeah, yes.
Okay, so do you have to make your payment every month?
Yep.
Yes. Okay. What happens if you don't make your payment?
Well, I'll slowly get a letter saying, hey, you need to make a payment. You're going to go into forbearance, and it'll eventually lead to foreclosure, and they'll take my house and kick me out.
Yes, and that's not a good thing to have happen, right? So, Justin, if I was to offer you a loan today, that from this time moving forward, your principal and interest payment would be optional. You can still make them, but there's not going to be any letter sent to you. You're not going to get any phone calls, or any nasty messages. Your credit's not going to be hit. Nothing bad will happen if you ran into hard times. Would you take that as an insurance policy on your loan today?
Yeah, absolutely.
No, why not, right?
Because you can control the cash flow.
Absolutely. Okay, I'm going to make the deal even sweeter, Justin. Every payment that you make not only is going to lower down the loan balance, but it will also go into a line of credit where it's liquid and where it's growing. And you can take that money back whenever you want if you ever needed it. Would you take that today?
Yeah, it's the opposite of the way it is now.
Right. Right now we put our money in, right? And it turns into this 100%, and we can't take it back unless we sell the house, we do a cash out refinance, or we get a home equity line of credit. So that's going to be, those are the issues that we deal with, right? And as we get older and we get to a point that we're not working anymore and we want to retire, the amount of money that we have coming in is so important. Why would we want to continue to make these payments in order to keep our house if we don't have to? And if we have the ability to stop making these payments, now we can, and we just talked about some of the cool things that happen if we do make them. But if we don't have to and we can use these for life, that's going to be important. And there's other, considerations too, Justin. We look at long-term care. We look at the potential for, life insurance. We look at, other ways to help kind of manage money. Well, if we just freed up, let's say that your housing payment, and you're 62, let's say your housing payment is $2,000 a month. If you no longer have to make that payment and can self-direct it somewhere else, could it be used in a better way?
Right. Most likely for a lot of people, the answer is yes. Most people have businesses, like a lot of these dentists that we're talking to here. They have a business. They haven't given up their business yet, and those dollars can be used to grow their business or prep it for sale or be invested somewhere. There's a lot of other uses that can expand those dollars outside of just being expensed.
So one of the things that I'd like to do here, I'm going to share my screen if I can figure out how to do this. There we go. And I'm going to give a little bit of just a scenario here. Justin, can you see this okay?
Yep, we can all see it. Yep.
Perfect. So here's our client. Okay, so they're 63. They've got $150,000 that's in their growth account. We're going to call it our savings account. And it's growing.
It does say it needs to be reloaded, at least what we can see. It says disconnected, page needs to be reloaded.
Let's do stop sharing. And let's try this again. Are you able to see that okay?
Yes.
Okay. So here's our client. They're 63. They've got $150,000 as far as their growth account. So this is 401ks, IRAs. It's making 5%. The property value is $600,000. And I'm actually going to put in here, give me 1 second. I'm going to put in here that they've got a loan balance. Okay, so they've got a loan balance of $100,000. I'm going to say that they've got a killer interest rate of 3%. And let's say their monthly payments on this are $1,000 a month. Okay. So when we look at this, this is their existing mortgage, right? This is their borrowed amount. They're making payments. The house value is $600,000. Now I use a 4% appreciation rate on the value of the house per year. That's kind of our historical average. Equity position is going to be the value of the house minus the amount borrowed gives your equity. And again, they've got this growth account. But right now, this particular person is paying $1,000 a month or $12,000 a year. And they're going to do this for 115 months. So this is their current mortgage balance. And you can see, you move this forward, by the time they're 73, they would have paid off this mortgage. Okay. But what happens if they were to decide to do a reverse mortgage? Okay. First and foremost, the closing costs that are associated with this get wrapped into the loan. All right. We call these opportunity costs. So when you look at a reverse mortgage, you say, okay, for this particular client, about $25,000 is going to be added into this loan. But what does that give me as far as the client? Okay. Initially, right off the get-go, principal and interest payments become optional. So if I move this forward 1 year, if we look down here, this difference in cash flow, that's $12,000 in payments that this particular person didn't need to make. You'll also know that the line of credit up here starts at $75,000, and this is a money that is available to this borrower, this client, and it's grown. That's because the line of credit has a growth rate. And so after 1 year, they would have saved $12,000 in payments they didn't need to make because, again, they've got a reverse mortgage. They would have still paid property taxes, insurance, and HOA if applicable. But they've got a line of credit that's $80,000 strong. So this number plus their savings gives us a liquidity position of $238,000. This is available to them. Okay, this is money that they can draw, and they've been able to save $12,000. What this shows here, this is what they're currently doing with their mortgage, and then this shows what would happen if they do a reverse. So if I move this forward year after year, we're going to be noticing that, hey, over here, if we continue doing what we're doing, we're going to pay off our mortgage balance eventually, right? Over here, we're not making payments, but we're saving those payments that we didn't have to make, and we're just kind of retaining them in our checking account. After we get to 73, you're going to notice that over here, they paid off their house, but here they were able to save $115,000 in payments they didn't have to make. Plus, their line of credit has grown to $153,000. You add that to the savings of $247,000, that gives a liquidity position of $400,000. That's awesome. So total liquidity position is either 247 or it's 400 plus the 115 in payments he didn't have to make. So that would give you a total liquidity position of 515,000. That is more than double the liquidity that you have over here. And so when you're looking at the two scenarios, this is what you're doing currently with your normal mortgage. Over here, you do a reverse, it pays that off, and your liquidity position is still super strong. In other words, we've taken equity over here, right, which is lower than it would be over here, and we've transitioned that equity into money, right? Cash flow, liquidity.
Yeah. I think this is really powerful because in my mind, we need to be making financial decisions that increase our permission to experience life. And so this is giving that client on the right the permission to experience more. Like maybe they didn't have the cash flow or didn't feel like they felt comfortable enough to travel and experience, but now they're using that difference in cash flow to go experience things, to go on the vacations and to go do those things. They're using those dollars to go do that because it gave them the permission to do it. And so to me, that's what I think our financial decision should be about is, does it give me the permission to do this? And in this case, the reverse mortgage offers that permission.
It does. And then when you look at this as well, this is money that we've just kind of saved over those 9 years and put in our checking account, right? That 115,000 in payments we didn't have to make. But, Justin, there's some fun things that we can do with this money and not keep it in our checking account. What would happen if we took that $1,000 and we put it into a vehicle that had a growth rate? There's a lot of different programs, obviously, that you guys offer. If I was to come to you as a client and say, hey, I just did a reverse mortgage, I no longer have to make my monthly payment anymore. I'm saving $1,000 a month in a payment I don't need to make. What could you put that somewhere for me where it could do something? And this is an example to say, okay, what happens if I self-directed that payment into a growth account? And you can see that contribution here going into a savings account that's growing. If I do a side-by-side here, again, the only difference that's happening here is instead of making my payment here, I get a reverse. I don't have to make it there in my loan anymore, but now I'm going to self-direct it into this account. If we move this forward and we get to that same time frame at 73, look at the difference in liquidity. That growth account, because we've been funding it and it's been growing at 5%. We now have a liquidity position of $550,000 instead of $247,000. Again, you're looking at a position where you've, in essence, doubled your liquidity. And I know that the market's going to move this however it chooses to, but there's a lot of different vehicles that money could go into instead of becoming equity in a house.
Yeah. Still usable dollars. We want to have usable dollars specifically in retirement more than any other time in our life. We need usable dollars in our hands and at our access, and equity is not a usable dollar.
Correct. The other cool thing, I'll just highlight this. What happens if you just make a payment, okay, on your reverse mortgage? Again, we talked about that. If you make a payment on a reverse, it's going to do three things. We'll lower down loan balance, dollar for dollar go into your line of credit, where it's liquid and you're able to take it back out, and you've paid some interest. So if we move this forward, you'll notice that, again, we're making optional payments. We don't have to do this, but that line of credit, that money is in that growth account that's available for us to draw. And if we do a side-by-side between these two, again, the only thing different is instead of making the payment here with our current mortgage, which is what we're currently doing, we decide to do it here. That payment is going into that line of credit at the same clip. And by the time we have this paid off, we have a projected very nice, robust line of credit added to the savings. And again, a great liquidity position on money that we could use.
I really like there's flexibility, there's options. It's going to fit with what is best. And you can do splits. You could save some of it in an outside account, and you could put some in the line of credit. And because the line of credit's optional, you don't have to do it every month. Like everything is in your control. It enables you as the the doctor that's either about to retire or going to retire soon. It gives you control over your money in a very powerful way versus just hand it over to the bank and then never get it back. So
Yeah,
I love
exactly.
this.
Well, and let's kind of hit on, something that we haven't yet, and that would be if, you've got a doctor that's looking at, making a move in retirement. Let's say that their house doesn't fit them anymore. And let's say, for example, that they're selling a four, I'm going to switch over to this tab here. So let's say that, they're 63 and they want to buy a home. And the home that they have right now is $500,000. And let's say that they would like to upsize to something that's, say, $700,000. Okay. In a traditional sense, they would have to come in with their $500,000, right? That they just sold their property for. And they'd have to get a mortgage for $200,000 to cover the difference between the 700 and the 5. Well, no one wants to have a mortgage payment at 63 on a $200,000 mortgage. But what they could do is they could choose to use a reverse mortgage to purchase their next house. And they would have to bring in, as far as where we stand right now with our interest rates and, where we're sitting with, the values that we can use, they'd have to bring in $493,000 to purchase a $700,000 home. Well, that allows them to upsize into a home that would better fit their needs. At that point, moving forward, their principal and interest payments would become optional. And, they would still need to make, their payments for property taxes, insurance, and HOA if applicable. But this would give them the ability to get into a home that better fits their needs. Just to throw in a little bit higher value here, let's say they're wanting to buy a $1.1 million house. Their cash investment right now with our expected interest rate sitting at 6.625, they'd have to bring in about $770,000 to buy a $1.1 million home, which is really cool. It allows them the flexibility to get into a home that's going to better fit their needs, and really right size into a home in retirement.
Right. And just to make sure I'm on the same page as you, is this doesn't, if you get a reverse mortgage, it's not locking you into your current location. You have the flexibility to still move into a right size home or to downsize or to move around with your reverse mortgage. And that's what we're seeing here. That's what you've been highlighting. Is that correct?
Yeah, absolutely. In fact, I'll just kind of show what this looks like so that they've got an idea. So we haven't really talked about what happens at the end, right? As far as, the loan itself and, kind of what this transitions into. So at the end, there's going to be an equity position. So what this chart shows here is, if you buy a home for 1.1 million, you've got to bring in your cash investment. You're looking at a mortgage balance that would slowly start to increase through time. Well, at the same time, the property value is projected to increase as well, and we have that at 4% per year. Equity position is projected to rise as well until we get into, about, our 80s, in that range, and then it starts to tail off a little bit. But let's say, just to take this out, let's say that they were in this home for 20 years, okay? They purchased it. They haven't had to make monthly mortgage payments. The loan balance, if they haven't touched it, would be projected to have grown to 1.5 million. However, the value of the house at a 4% appreciation rate would be projected to be about 2.4. That means that there's still about $900,000 of equity remaining. Well, they could, if they decided they wanted to move, they could, list the property, sell it, pay off the mortgage balance, and they would have about $900,000 projected equity that they'd be able to take with them and use this program to purchase another home. And you can see that equity position grew or was projected to grow during that period of time. Now, interest rates are going to do what they do and values are going to do what they do. But if we take a historical average of 4%, this is what the numbers actually show.
Awesome. That's really powerful. Is there anything else that we haven't talked about yet that you think is important for for doctors to know when they're approaching this reverse mortgage space?
Yeah, I think, Justin, the biggest thing is to open their minds up to the possibility of using this program. This is another pathway. Um, for doctors that have planned well, they've got a good retirement. They're doing great. Hopefully they've been able to save money and put it where it needs to go so that they can enjoy their retirement. But even if that's the case, this offers another path, another bucket of money that could be available for them to be able to use in a coordinated strategic plan to allow for more cash flow, save money in taxes, and put them into a better spot financially. It is super, super simple, Justin, for us to be able to throw together a scenario and say, okay, well, what does this look like for me? How would this benefit me in retirement? Maybe I have my house paid off, and would doing a reverse mortgage be a smart thing to do? That's what we love to do. We love the planning side of it.
Yeah.
And you and I, work really well together to provide some different options and pathways to look at. End of the day, it's going to be what is most important to each one of your clients and the doctors to say, this is what's most important to me, because I want to have cash flow, or I need this or that. And then we can design a plan that can work for them.
Yeah. I do want to mention, because this is something I hear sometimes when we see people they have planned well, they've saved a ton of money, they have plenty. They're going to say, well, it almost feels greedy to them, or they almost like want to hold back because it feels like it's too much money. And you can never have too much money. It always opens you up to more opportunity. This could be okay, now I'm going to have the permission to be more charitable. This could unlock that for you. Don't ever hold back from, this is what you earned. You built this up through your life. This just unlocks that money for your use. So it's not something you should feel guilty about. Even if you've done really well, it can still be the next piece that gives you permission to do something even bigger. Maybe you want to leave a bigger legacy for your children, your grandchildren. That unlocks and gives you the permission to do that. So don't just hold back because you're already planned well. This can just be the next piece to give you the next bit of bigger thinking and bigger planning. Don't put a ceiling on your ability to use the money and wealth that you've built.
We talk about inheritance and passing that to heirs. We can give our inheritance away with a warm hand or a cold hand, as we like to say it. A warm hand, we're giving it away while we're alive, and we can give that money away judiciously to our kids and grandkids, or to charitable places as we see fit. That's something that a reverse mortgage can allow for you to do. Giving it with a cold hand, we've passed. Basically, the kids figure out how they're going to use this and what they're going to do with it. But I love, I'm working with a client right now. He does not need this program. He's got a few $1 million in the bank, owns multiple homes. He is using this program as a safety blanket. The line of credit grows and will continue to grow. But if everything goes south in the stock market and he loses a lot, in that given year, he does not want to take money out of his accounts in that year. So he can take it out of the reverse mortgage as far as in the line of credit and use that money to supplement what he needs in that given year.
Yeah, that's where it really, to me, that's the biggest piece of excitement. That's gets me most excited, because if you can do that, instead of your assets going through this rise and then slow fall as you use them, if you can supplement it with the reverse mortgage or life insurance, your assets can continue on an upward trajectory even as you pass, which means you're leaving a bigger impact. You're leaving more, and you can designate where it goes. So that really gets exciting because it opens up more possibility. And when more possibility is open, an innovative business owner, entrepreneur, thinker can think of things to do to solve that problem instead of it just being handed off for a future generation and spent and like a trust fund baby. You can come up with a solution to make it so that you're creating a never-ending inheritance, a never-ending legacy that's you created for your family. And so to me, that's where it gets super exciting, as the reverse mortgage can be that piece that makes that a reality.
Yeah, absolutely.
Awesome. I thank you, Matt. I really appreciate you coming today. Last thing I want you to say is, how can people get in contact with you if this is something that it's caught their ear, they're interested in it. They either want to do proactive planning or they're at age 62 and they want to see what's best for them. What are the options on the table? How can they do that?
Yeah, I know that's great. So the easiest way, my phone number, 801-330-2200. Again, 801-330-2200. Give me a call. More than happy to run through scenarios. You can also reach me at matt.harrison@movement.com. And either one of those allows me to kind of pull together scenarios. It's super simple for me to do a quick video as well, Justin, if they want to connect with you directly. And you can give me just basic information to run a scenario. We need birth date, how much the home is worth, if there's any existing mortgage on it.
Okay.
And from that, we can pull everything together and let you know what this looks like for you.
Awesome. Really appreciate it, Matt. Thank you. And I hope everyone had their eyes open today about this dead asset being turned into a live asset. So thank you, Matt.
Thank you.